Hi guys, my name's Andy with the Exit Advisor. Today I sat down with Charles Skinner, formerly of Brandon Hire. He's also the CEO of Restore PLC, as well as the chairman of Alliance Tool Hire. We spoke about his time at Brandon, how he scaled from 10 depots all the way up to over 140, how he exited the business, some lessons learned, a company he worked at straight after that, as well as acquisitions and his kind of thesis on M&A. Now, we also spoke a bit about his book, Buy, Run, Build, which is available at Amazon. I'll post a link in the show notes below for that. So with that, let's get into the episode. Thanks for watching.
The Brandon growth story. I think most people know who Brandon are. If they don't, they've obviously been living under a rock. But they probably know what the business is, but then they're not familiar with the growth sort of story behind it. So can you speak to that a little bit and talk about maybe the acquisitions that you made during the process?
No, great. Well, the history of Brandon Hire was set up, I think, in about 1980 as a tool hire business in Bristol, named after Brandon Hill in Bristol.
Mm-hmm.
And it was then subsequently floated on the USM as was the unlisted securities market, which was it was probably too small. It was it was only turning over 4 million. And so it was an odd company to be that small to be quoted. And the three original partners in 1994 had begun to think about where their future lay. And somebody who I'd advised when I was working in M&A at 3i, John Laycock, I'd advised him on selling his business in the late 80s, and he was looking for something to do. We found Brandon Hire, and we bought into the business as a quoted company in 1994. I then was a non-exec director, and I was non-exec director of Brandon for 3 years. And during that phase, we started to acquire more businesses. We were very much a Bristol-based business, and with operations in Somerset and Bath, but really it was a sort of Bristol-based business. We started to acquire smaller tool hirers using the funds which we could raise from the stock market. And in 1997, as it had grown bigger, I came in as CEO. And I guess at the time, the tool hire industry was very fragmented. HSS was by far the largest player. Speedy was beginning to grow quite rapidly. And we could see that there was an opportunity to achieve national coverage, to grow the business. And the goal was national coverage. And we generally preferred to do that through acquiring tool hire businesses rather than setting up on our own. Quite often you'd have a town or a small city where there might be a strong independent. The independents could see that it was getting tougher to compete with the nationals, cheaper access to capital. And so over that period of time, I think in 1994, Brandon Hire had 10 branches, and by 2005, we had about 120, I think, with national coverage around the UK.
Your original goal was sort of national presence. How did you said that you funded some or all of them with funds from the balance sheet? So were you borrowing any money, or was this all just purely your own cash from within the business to acquire?
There was a bit of cash generated from the business. There was a bit of borrowing, but the main source of capital was from our quote so we were raising money from investors. Mm-hmm. to mop up the market.
How did you sort of, because that's quite a leap to go from 10 branches to over 100. How did you put the infrastructure in place to kind of manage that process? And did you have a team or a specific person within the business that was just purely looking for acquisitions? And I suppose the follow-on question for that would be, what were the quality of the businesses that the target businesses you were looking to acquire? What were you looking for in the context of that?
One was particularly looking at retirement sales. A lot of people had been in the industry for 20 years They might have started when the industry started kicking off, and the age of 30, 40 or whatever, say they were coming up to 50, 60. It's a capital intensive business, as you know, Andrew. So quite often not having access to capital limited the amount of kit they could buy, and therefore what their revenues were. So there was a demographic implication around where things were. There was also a time when previously a lot of the big construction firms would use a lot of local suppliers, and increasingly they were preferring to deal with one or two national suppliers, which meant that previously, if you were in Blandford Forum and a big site kicked off there, if you were Blandford Tool Hire, you would get work. Increasingly, you found that Brandon or Speedy, or to a lesser extent HSS, even A-Plant in those days, would get the work because they had the national contracts, which meant that a lot of small tool hirers in the old days did very well when there was a big local project, but actually projects were increasingly being undertaken by the nationals, and the nationals wanted to use a national supplier. So that rather squeezed out the high volume, high profit contracts for the smaller operators. Mm-hmm. So that was something which made the market less attractive to the smaller operators.
I just want to kind of explore acquisitions a bit more, because I think that not enough people look at acquisition as a way to grow rather than purely organic sales and hiring more people internally, et cetera, et cetera. So was it just, you mentioned about demographics there, was it just kind of the aging, retiring demographic that you were looking at, or was there anything else? Were there any other kind of?
No, it was clear that we needed a network, and we wanted to have a branch within where particularly major conurbations you get to site in less than half an hour. So it was really about looking at the map of who was in certain areas where we felt we needed to be, and seeing whether they were interested in selling the business.
How do you sort of assess performance? How do you grade whether or not they're a good acquisition target versus just going in there to steal their market share?
It was really about their market share, and the key thing was typically in an ideal situation the owner would be less engaged in the business, and their team on the hire desk would hold the local relationships. Mm-hmm. So it was really about trying to acquire the local relationships. Obviously, one looked at the quality of the kit. One looked at the situation with the property. Was it a freehold? In which case one could pay the owner an ongoing rent. So there was quite a lot of different features, but generally it was about acquiring customers. Okay. And it's tough when I've set up brand new branches, and it takes quite a long time for customers to get used to you, particularly if they're happy with their existing supplier. It's very rare that you can, unless you find a local manager who knows the market really well. If you set up a greenfield site, it can be very, very difficult to get going, and you've got a lot of expensive shiny kit sitting around waiting for the customers to turn up, and if the customers are happy with their existing supplier, why are they going to come over to you?
No, okay, no, I understand that. And in terms of like cultural integration, if you bought, I don't know what the numbers were, but 100 over 10 years, or grown from 100 over 10 years, you're sort of.
So some of them would have been multi-branch businesses.
Mm-hmm. But I mean, even so, that's almost one a month sort of thing. So how do you integrate and move at speed? How do you acquire at speed and then integrate these businesses under your main sort of holdco?
Well, we had a very good operating system. And after you've done a few of these deals, you have a team who will arrive, who will install a change of IT equipment. They'll recode the fleet. They'll do the branding of the site. And those teams, which were probably typically 3 or 4 strong, would stay with the branch for anywhere between 1 and 3 months, just making sure that everybody was comfortable with the new systems, that the fleet was on our systems, that the customers were informed there'd been a change of ownership, but they wouldn't, nothing would change as far as they were concerned. Just they'd have more access to equipment.
Mm-hmm.
One of the key things then was also the ability to, we were always moving a lot of kit around between the branches, so that rather than an independent who would have to cross hire or would have to go out and buy equipment when particular demands came through, we could say, well, actually, we've got these three mini diggers over here which aren't working. Then let's move them from Hereford to Ledbury, or from Solihull to central Birmingham.
So you had that kind of...
So the utilisation of the equipment was much higher because it moved around a lot, and that enabled us to generate more revenue on a lower capital base, because the utilisation was up dramatically, which was something which I used to monitor very closely. You'd hope that all of your equipment was paying for itself on average within a year.
Mm-hmm, mm-hmm. Okay, that kind of leads me on to my next question, really, which was, you've built a team to run the sort of operation at this stage. You've got over 100 depots. What's kind of your role look like on a day-to-day, and what are you looking for to make sure that the business is going in the right direction? Because obviously you can't visit every branch regularly, or as regularly as you'd like to. So what are you kind of looking for in terms of metrics or KPIs or business performance that lets you know that you're on the right track?
Well, every branch would have its own P&L. Every branch would also be charged cost of capital. So instead of paying a fee to head office for various functions, we would charge the branches an amount depending on how much equipment they held. The rationale behind that was that as a group, we were judged on return on invested capital, and therefore we transferred that down to the branch managers, who, if they had £1 million worth of kit, that was going to cost them 200. We were going to charge them 250 grand a year for having that kit. So they knew that if they could reduce the amount of kit they had, then that charge would be lower. So it encouraged everybody to use the kit more efficiently. How it used to work was we would, my finance director and I would visit the areas once a month, so possibly be 6 or 8 areas, and then we would go through the performance of the individual branches. We go through their customers, who were their new customers, who were their down traders, who had people who had been a customer, why were they no longer with us? We look through the credit notes, because the credit note will tell you when you're letting your customer down, if you're having to give them money back. We'd also look at the invoices in query, which would tell you, invoices in query would tell you when our systems were failing. Because if the customer says that wasn't the right invoice, you knew the systems were wrong. Whereas with a credit note, you knew that you delivered, that you'd failed operationally. So there was a triangle of control around health and safety, queries and credits. We go through the P&L. It's very easy to compare one branch with another and say, this branch is doing 100 grand a month, that branch is doing 50 grand a month. How come the one doing 50 grand a month has got the same number of trucks and blokes as the one doing 100 grand? So you benchmark the performance of those branches.
That's a really interesting point there, because I think a lot of people tend to focus on, when you've got an underperforming branch and a performing branch, I think a lot of people look at the underperforming branch and try and ask questions why. But I think I've heard you in previous interviews talk about focusing on the one that's doing well and trying to learn lessons for that. Is that, can you speak around that?
Yes, you end up with, in a lot of businesses, particularly multi-branch businesses, or like the business I run at the moment, which we do lots of different things. You can end up often spending your time trying to sort out the duffers, and not focus on why are these branches doing well? Should we be getting them more kit? Should we be getting them more salesmen? So it's a balance. Clearly, if you've got a branch which is losing money, you want to find out why, and you want to work out whether it's cost, whether it's the attitude as management, whether it's because the local customer base is just very quiet, and sometimes that can be if you've got 5 big sites on in a town, that's going to perform better than when you've got 1 big site on. Yeah. So you look at all the differences, but you'd also be looking at branches which were flying and going, how can we get more business for this branch because it clearly knows what it's doing.
Nice. Okay. So Brandon eventually gets up to, I think is it 140 branches? Is that right?
Yes, it's probably about that. Yeah, and the market value by then was about 100 million.
And what was the decision then to kind of exit and sell to Wolseley?
I think the key elements was that the builders merchants were trying to get into tool hire. A lot of them had existing tool hire operations which weren't very good. They realised they weren't very good, and they were on the hunt to increase their share of the builder's wallet, and they thought a move into tool hire would help them achieve that. By that stage, we had pretty decent national coverage. There were a lot of players in the market: Speedy, HSS, Ashtead, Gap, who weren't really involved at the smaller end. VP were trying to grow their hire business. There seemed to be a lot of, and then you had the builders merchants. Travis Perkins, Wolseley had operations which they were trying to grow, and it felt like there were too many players in the market and that we were a very attractive target. So it was the right point for the shareholders, who I think made 5 times their money in the last 5 years. It was time to reward them.
Okay, and on the exit, I've spoken to a few sort of exited founders recently who link a lot of their identity to their business, and you're sort of riding the wave, particularly you in charge of so many people and so many branches. What was life like after the exit for you? Did you feel a lot of identity tied to Brandon, or were you ready for the next challenge? Kind of how did that shape out in your mind?
I think it wasn't. It was interesting. I wasn't the founder of the business. It had been going for 15 years before I got involved, and my job was very much to buy and build the business. Mm-hmm. And one of the advantages of selling to Wolseley was that Wolseley recognised that their own tool hire offering was weak. So effectively, the Brandon business took over the Wolseley's hire operations, which meant that all my colleagues ended up with bigger roles rather than being made redundant. Mm-hmm. So that was a particular attraction of that transaction. From my point of view, I'm more focused on being involved in business than I am on individual companies. Mm-hmm. And it was a slight wrench, but it was really only a wrench. It wasn't a wrench. It was a wrench around the people, not around the business. I worked with some very nice people, really good people, and to leave them, but at least I was leaving them in a very comfortable place. So that was fine, and I was looking for something else to do.
I think that leads us nicely to your next role, or the one after, which was about Johnson. I've heard you say that you were dealt a poor hand and you played it abysmally. Do you mind talking a bit about why you think that didn't work and what sort of you learned from the failures in that role?
Yeah, I mean, in my book Buy Run Build, published by Bloomsbury last year, I described the fact that after Brandon was sold, I stayed on for a few months at Wolseley, but I'm not really a divisional MD in a big group. And so I was taking time off for a few months, and then I was rung up by the biggest shareholder in Johnson, who'd also been the biggest shareholder in Brandon, who said they'd kicked out their chief executive. I think you should have a look at this job. And I was quite keen. I think I was actually in India at the time when I was approached, and I thought, well, that's the next step up. 10,000 people, much larger business, seemed to be. Seemed to have a lot of business-to-business services dynamics. I was aware there were problems in the business, but my foolishness was not to really look at the business before I went in. I just went, yeah, fine, I'll be the CEO. But on arrival, it became clear very quickly that the banks were very unhappy with the business. They were that there was some elements of corruption in the business. Different divisions were operating wholly independently of everything else. There were a lot of problems, and if I'd undertaken better due diligence before I went in to take that role, I would have been aware of those problems rather than trying to paper over the cracks. And by the time I'd unearthed the scale of the problems, it was too late. Wow. So I was at Johnson for 8 or 9 months, and then I realised that it needed a far more substantial overhaul. It needed more money from the shareholders, and that because I'd approached it in the wrong way, trying to defend the shareholder value in the business when actually the banks de facto controlled it. That at that point I felt that I was the wrong person to take to sort of go through the 3-year grind of working it out from its problems.
So I guess the solution there was to do more. Well, looking back on it, would the solution have been, do more due diligence before accepting the role?
And go into the role and say, this business has huge problems. It's not worth the money which the stock market thinks that it is. It's worth substantially less. And Mr. Shareholder, you need to put up some more money, or else the bank's going to take control here. That's what needed to be done, instead of what I was doing, which was saying, actually, we've got some good businesses here. They just need tweaking.
Okay, so you mentioned your book, which I was going to bring up. The book is essentially about buying a business versus starting your own. And I think, as I alluded to earlier, I think too many people kind of overlook that. But I do want to talk a little bit about passion and why following your passion might not be the best route in terms of owning a business or operating a business. Where do you fall on that? I think you might share my views with following your passion.
I think there are two points here. One is that a lot of people feel that if they want to be their own boss, they've got to start up a business. And even in something like tool hire, you may be better. It's a long haul in terms of investing in the kit, etc. You may well be far better off finding an existing tool hire business and approaching the owner and saying, if you want to retire, I'm happy to take on the business. I'll pay you something for it and pay you a bit more down the line, is probably an easier way to do it than to start up from scratch. And I think that applies to lots of other industries. But it also applies to people who think, I want to run my own business. I've got to have a great idea. No, much better to buy a smallish business in a sector which you can relate to, and then take it to where you want it to go. And I think similarly, the point about passion is, the reason why restaurant shows on restaurants being run badly is so popular is that a lot of people do follow their passion and discover that it's not a particularly commercial area that they're operating in. So I like to run companies, and I like certain features in them, but I'm not too worried about the sector. And I'm not worried if very few people at the age of 15 say, I want to run a shredding business. But but I want to run a business-to-business services with reliable revenues. So that's where that one goes, Andrew. Yeah.
Okay. And in terms of something sort of useful to take away from people listening to this or watching it, other than obviously going out and buying your book and reading it, have you got any kind of top tips for people who are maybe employed at the moment and thinking about, eventually owning a business or running a business? What the pitfalls might be, things to look out for during due diligence, or kind of performances of businesses that they're looking at?
Yeah, I mean, it's quite a big question, that, and the books are.
Summarize it in 30 seconds for me.
So I think the thing is to look for areas where you can see potential growth, and that the skill set that you can bring to a business will enable that business to grow. I think you need to accept that if you buy into a business, just because you've got the badge doesn't mean that you're immediately regarded as the sheriff, and you need to work very hard on the people. But that's fine. Once you've got the people on board, and you understand what the business is doing, and you've retained your customer relationships, then generally you can come across businesses where the impact of AI or decent IT or whatever, you can bring energy to it. And quite often, people reach a certain age and the business is coasting. They're thinking about their retirement, and that is representing a great opportunity to build on and to buy into them and build on them. And also, as I take people through in the book, you don't necessarily. It sounds like you need money. You don't necessarily need that much money. Because you might find the vendors prepared to take money from you, be paid out over time. You might find there's a freehold you can borrow against. There may be a debtor book. So quite often, a lot of these transactions, people think, oh, well, I haven't got 3 million quid. You might find that actually other sources will supply 2.5 of that, and then families and friends and you can fill the rest.
Mm-hmm. Nice. Okay. And then finally, I think it'd be good to talk about your current venture with Alliance. What's the kind of thought process behind that? And obviously the market is probably different to how it was when you were running Brandon. What are your overall goals there, and how do you see the market changed since the
I think most of business is about luck and timing, and it was luck that we sold Brandon in 2006. Because 2 or 3 years later, with the financial crisis, construction industry stops. Tool hire businesses have got very high fixed costs. So when you get a big down, as any tool hire operator will know, when you get a big downturn in revenues, you can't cut the costs because you've got properties, you've got people, you've got kit, which is it's got to be paid for. So it was a wipeout for most of the tool hirers in some form or other. People like, again, the 2 main players, HSS and Speedy, their balance sheet never recovered from that. Mm-hmm. That they were shocked that that they ended up with too much debt, etc. And then but then the timing element was in about 2012. So I've been out of the business for 5 or 6 years. 1 or 2 of the people I used to work with were upset with what was going on at Brandon, or they'd been somewhere else, and so that's when I backed three different businesses: South Coast Tool Hire, London Tool Hire, and Edge Tool and Equipment Hire, which is a disaster recovery business. So, and that was really just backing old mates. With one of them, it was with the former finance director of Brandon, and the other 2 was with the former chairman of Brandon, and we invested in them then. And so that was sort of 2012. And one knew that the construction market was recovering. One knew that the other hirers were in a weak position because of the fact their balance sheet had been shot during the financial crisis. So those are sort of those all did pretty well. And then about 5 years ago, we put London Tool Hire and South Coast Tool Hire together to call it Alliance. A couple of the shareholders retired. We brought in a young Harvard MBA to run it, and she was probably about 30 when she started running it. She's brought in a bigger, a very high quality finance director. Mm-hmm. So Alliance Tool Hire itself is now up to about 14, 15 branches. And also along the way, I and the former Brandon chairman, there was a team in Cornwall, which we thought was very strong, and we backed them. And now we've got 4 branches in Cornwall. So we think that the opportunity, particularly against a backdrop where Brandon Hire Station has closed a lot of their branches, where HSS has basically stopped trading. I think there'll be confusion about HSS's customers being pushed on to Speedy. So we see this as a great opportunity for growth. Mm-hmm. In terms of there are some very, very good tool hire people out there who are looking for work and who have strong customer relationships. So we think that's a very exciting space. We think Alliance Tool Hire, which has always focused on the county builder rather than the big nationals. The big nationals make you run around for no money, and I think that was a market which we've avoided. And we also believe that you're only as good as your branch manager. So if you've got a good branch manager, they'll do great stuff. If you've got an average one, and I think a lot of there are a lot of very good managers in the tool hire industry, and I think that the nationals have started treating them as delivery boys. Using AI for predictive. Where should the kit be? Builders were being told, you've got to place your order through a call centre. If you wanted to know where your kit was, you had to look at, you were told it's fine, you just go on the customer app and you can see where it is. Actually, that's not what a lot of big local builders want. They want the relationship. They want to be able to ring up Sid. They want Fred to tell them they're going to be late to site because the ring road was knackered, as everybody saw it was when they came to work. It's that personal relationship and that's what we're building Alliance Tool Hire around.
Yeah, great. Amazing. Okay, I'm conscious of time. So I know you've got your book out and you're sort of quite active on LinkedIn and socials and stuff now. So what's the best place for people to reach you and to find the book?
Well, you're always keen to chat to people to LinkedIn. The main sources of if you can buy Run Build on Amazon. There's an Audible version. There's a Kindle version. It's just been published in the US a couple of days ago. Pleased to see that it's the third best-selling book on small entrepreneurship, published in 2024, in 2025. It's also very funny. I don't know whether you read it, Andrew, but most of it is about you learn from your mistakes and how we do it, and a lot of it was clearly built up on the back of working the tool hire industry.
Fantastic. All right, I'll put a link to it in the show notes. Okay, so let's park it there, Charles. Really appreciate your time and thanks for sharing the story.
Thanks, Andrew. Really nice.